Today we continue to explore ways to invite the world to experience the Australian way of life. But are the global economic conditions right for continued growth of inbound tourism to Australia? And does the outlook change across different markets? We're pleased this morning to welcome Paul Bloxham. He's HSBC's Chief Economist for Australia and New Zealand, and he's here to answer those questions and more. After Paul's presentation this morning, he will facilitate Q&A from the floor, so once again, have some questions ready to be able to make best use of that time. So what we all really want to know from Paul, first up, I suppose, is what's the size of the prize? Please welcome Paul.
Thanks, Sophie, and it's a great pleasure to be here, and thank you very much. Thank you, John, for the invitation to be able to come along and talk to you about what's going on in the macro economy, bringing it back to what's happening here in Australia, and then at the end I want to talk a fair bit about what's going on in the tourism industry and how it links into that global story too. I have a challenge. I only have 45 minutes to do that, which is quite tricky. I got to try and keep you guys interested in a story about the macro economy after watching all of those various videos that John put up, but I'm going to try to meet that challenge nonetheless. I really enjoyed that presentation from John in particular. I learnt something about the fact that Turtles and Chris Hemsworth are both on sort of the list of candidates for potentially advertising Australia, and they come up in similar sort of ranks, I take it. It's a pleasure to be here. So the global macro story. Now, most of the news you get about the global macro story, you get through the newspaper or you get through your phones, and most of it's quite downbeat. And that's because the media tends to sell downbeat stories. Rarely does the newspaper want to tell you about something that's positive. Often if something's going up, they're going to tell you it's about to go down. If something's going down, they're going to tell you it's going down further, and that's partly because they're trying to sell newspapers, they're trying to sell stories. Rarely do they tell you that actually things are cruising quite well. So deciphering what is going on in the global economy and working out what is actually the true story is quite tricky if you're just a casual observer. And that's where I think my role comes in, is to try and pull the signal out of the noise and try to collect the data together and give you an overall story of what's going on. So in terms of thinking about the overall global picture and the overall global cycle, things are slowing down. Global growth is slowing down. That is the right characterization of what's going on right now. But they're not collapsing. Things are not really weakening in a sharp way. Things are slowing down. And they're also slowing down from quite a positive pace of global growth. And that bit I don't think people fully appreciate. Back in 2017, a couple of years ago now, but back in 2017, global growth was actually quite strong. It was running above trend. It was running at the fastest rate we'd seen since the global financial crisis of 10 years earlier. And it was quite broad-based. It was happening in the US, it was happening in Europe, it was happening in Asia, it was lifting global trade. 2017 was quite a positive year for the global economy. Last year, the global economy actually as a whole actually held up reasonably well as well, although there was an increasing divergence across the global economy. So to put some numbers on this, I didn't bring any charts along. I should have, because there's a really big screen behind me, but I didn't bring any charts along because I prefer to just try to explain things in terms that people can absorb. But in 2017, global growth was running at 3% if you do it in US dollar terms. Last year, it ran at 2.9%, so it barely slowed down, but it did slow down a little bit. But the main theme that was playing out last year was that the global growth, which was really quite broad-based in 2017, became more divergent in 2018. So the US economy raced ahead. US growth was very strong last year. The rest of the global economy slowed through last year. So US growth picked up to 3% in 2018. It was booming. The US economy had well above trend growth. And if you want to hold one statistic in your minds to give you some sense as to how the US economy's been traveling, the unemployment rate at the end of last year at 3.7%, which was the low point it got to, it's still at 3.8 now, but at 3.7 it was its lowest level in 49 years. So the unemployment rate in the US at the end of last year was at its lowest level in 5 decades. Gives you some sense that the US economy has been really growing quite strongly. Growth has been pretty good there. But the global economy, the rest of the global economy, slowed down through last year. China's growth slowed down. China's been implementing policy to try and constrain growth in its financial system. It's worried about longer-term risks of debt rising quickly. And so they've been tightening up their settings more. And if you look across the range of indicators for China, things like retail sales, industrial production, trade, fixed asset investment, all these things slowed through last year because they were tightening up those policy settings. And that was slowing growth down. And then the European economies also slowed quite a bit through last year. So the first half was okay, but by the time we got to the second half, Italy fell into a technical recession where GDP contracted for 2 consecutive quarters. The German economy stalled in the second half as well. Last year we had a contraction in GDP in the third quarter, and it was dead flat in the fourth quarter, so we had a slowdown in growth in Germany. So the short of it is, US growth was actually really quite strong last year and picked up pace, but the rest of the global economy started to slow down. Now when we think about where we're headed into 19, we think that both the momentum, a bit of the momentum is lost in those other economies, and that momentum loss will continue. So we think those economies won't pick up to the previous pace, and we think US growth will slow down too. So US growth was very strong. It's unlikely to continue at that sustained rate. We think growth will slow. Our global growth forecast is that we slow from 2.9 last year to 2.6 this year to 2.4 running into the following year. This is not a significant decline, a really sharp contraction, or a big downturn as the markets were sort of hinting at towards the end of last year could be possible, but it is a slowdown in the global growth story. Now, before I move on to talking about local and talking about tourism and how it fits into that story more, I want to talk about why it is that global growth's been slowing. Just to properly understand what's going on, you sort of need to look at the causes of what's been going on, and to be able to understand where things are headed, you have to think about those things as well. What's been slowing global growth down? So there are 3 key things that I think you need to think about. Now, there are lots of idiosyncratic stories that I'm going to touch on a couple of them a little bit later on for individual countries. Things like the fact that the Italians have elected a populist government and trying to get a big budget through. They've got challenges with their banking system. Things like Brexit that's going on in the UK, and sort of day by day and night by night you would have seen this morning more news on the Brexit story, an idiosyncratic story for the UK. Last year we had a financial crisis in Turkey and Argentina. But these are sort of specific events for specific countries. What I want to talk about is sort of 3 key things that have slowed the overall global growth story down. So the first theme is this. You should always have expected that global growth was going to slow a bit anyway, because global growth was running above trend in 2017. It was running above trend, right? And when things are running above average and things are very strong, you shouldn't expect that that's going to persist. That's why they tend to return back to their average rates. European growth was very strong in 2017, well above trend. It wasn't going to run at that rate. It was going to start to slow down, and indeed that's what's happened. The US growth story. US growth last year was running well above trend, and a part of that story was that the US administration delivered a very large corporate tax cut. If you recall, early last year, the US administration cut the corporate tax rate from 35% down to 21% in one foul swoop. And having delivered that big support for growth in 2018, without that policy necessarily being repeated in future, it's going to be hard for them to grow as fast as they were. It has a big support for growth in that year, and then it starts to fade. So we think that US growth will slow from about 3% last year to 2.4 this year to 1.8, which we think is about trend for the US economy looking out to 2020. So a part of the story, the first reason why global growth is slowing, is simply because it was running well above trend. It was actually doing quite well earlier on, and so it will head back towards its trend rate. The second big reason why we've seen a slowdown in growth has been the actions of policymakers. What policymakers have been doing in terms of managing the economy. Now, the main actor here that I'm pointing to is the US Federal Reserve, the US central bank, all right, the US central bank. And the US Federal Reserve last year lifted its policy rate, lifted its policy rate by a whole 100 basis points, 1 percentage point. Now, it might not sound like much, but in a world of very high debt levels and in a world where we've had persistently low interest rates, a percentage point of lifting interest rates is actually quite a lot. And it made sense for the US to do that last year because, of course, the US economy was booming. I just told you it was running at 3% and the unemployment rate was at a 5-decade low. But it has a reverberating effect across the rest of the world as well, because it's still the case that most of global trade and most financial transactions globally occur in US dollar terms. So a long period of low US interest rates has meant a lot of corporates, a lot of governments have leveraged up over a long period of time. And if you lift those interest rates, it makes things more costly. It tightens financial conditions, as we describe in economics. And so those tighter financial conditions in the US started to have an effect on the rest of the world as well. So part of the reason why global growth was slowing was because the Federal Reserve was lifting interest rates. Another reason why was, another part of that story was that, as I said earlier, the Chinese have been tightening up their policy settings as well. Chinese debt levels have climbed to a high level, and they're getting more concerned that they don't want credit growth to run as quickly as it has done in the past. They're worried that they're going to get more non-performing loans, that corporate debt might get misallocated. They're allowing more corporate defaults to happen. They're trying to work through and reform their financial system. And in doing that, that is and has been slowing down China's growth through last year as well. So two big actions from policymakers that have been slowing the global growth story down. The third one that's been slowing global growth down, and the one that you're probably most familiar with because it gets the most coverage, is what's been happening in terms of global trade tensions, the trade war, the trade protectionism that's been rising. A promise from the US campaign of Donald Trump was that he would deliver a fairer deal for trade, and one of the mechanisms he was going to use to do that was to lift trade tariffs. And he didn't do much in 2017, but by 2018 he moved onto that agenda in a big way. The Americans put in place tariffs on imports of steel and then aluminium early last year. Then they moved on to renegotiating the North American Free Trade Agreement between Mexico, Canada, and the US. Then they moved on to negotiating with China. And that involved them putting in place, as of September, a 10% tariff on $250 billion worth of manufactured goods that come from China. China reciprocating with a range of tariff measures as well. And the Americans saying that they were going to, intended to, lift that 10% tariff to be a 25% tariff by the time we got the early part of January. Now that sent the shivers through the global manufacturing industry, right? The global industrial production started to slow down, global trade started to slow down, manufacturing sentiment weakened, and it makes a lot of sense. Because if you're a global manufacturer, you're saying to yourself, where should I do my next bit of investment? Where should I do my next bit of hiring? The goalposts are all moving. How should I deal with this? And that weakened their sentiment, it weakened their investment, it weakened their employment, it weakened their production in general. So we've seen the industrial cycle roll over. So that's been the other thing that's been slowing global growth. Three big things going on. So then if you think about those three things and you sort of translate them forward and think, what are they going to do in 19, what are they going to do in 2020? Because that's the framework you've got to use for thinking about what's going on in the global economy. You've got to watch these big picture things, and they matter for Australia, and they matter for all of the industries, including the tourism industry. They matter what's going on in the global economy, particularly for Australia, because the shocks all come from abroad. We're a small, open economy. It typically is the case that if we're going to have a downturn, or even if we're going to have a boom, it's driven by something that's happening offshore. And so you've got to watch these things carefully. So if you track those three things briefly and think about them into 2019 and 2020, well, the first one, well, that's inevitable. If US and European growth was running above trend and it needed to slow down, it was going to slow down, and that's part of what's driving the story. The second one, well, that's actually changed a lot just in the last little while. The Federal Reserve, the US central bank that had been lifting interest rates all through last year and got to its policy rate to 2.25 to 2.5 by the end of last year, which is what they think is about neutral. It's the point at which the rate is no longer supporting growth, it's no longer holding back growth. Well, they've decided, the Fed has made it clear that they're going to be on hold for a little while. They've paused for the moment. They're watching what's going on. The market has taken that signal and said, well, actually, if you're going to pause, we're going to price that you're not going to do very much, and the pricing is now suggesting that by 2020 they might actually be lowering their policy rate. So this lift in interest rates that was delivering slowing conditions and tighter financial conditions for the world economy, well, it's actually not as clear now. It's clear that they've actually backed away to a degree. And if you follow the equity market, this has been one of the fundamental things that's been driving it, right? Towards the end of last year, this big sell-off in October, November, December, it was around the trade tensions, but it was also around the fact that the Federal Reserve was expected to keep lifting interest rates. The Federal Reserve came out in December and then January and said, we're actually backing away, and the market's been lifting. We've seen more promising conditions. So some part of that policymaker response is backing away. For China, the Chinese have started to pull the levers. They've started to support more growth. They're doing more infrastructure spending. They've loosened financial conditions. They've cut their reserve requirement ratio. They're pouring liquidity into their banking system to try and support growth. And last week, as a part of the National People's Congress, which is a big event for the Chinese authorities, they announced a large corporate tax cut themselves to try and support growth in China. The short of it is, China's growth has been slowing, but they are starting to pull the levers, put measures in place to lift China's growth, stabilise. We think it'll stabilise in the second quarter and lift into the second half of this year. And this is an important feature of what's going on as well. So the second factor that had been slowing things down is actually now starting to work in the other direction. It's actually starting to provide a bit of support for global growth. Well, the third factor, well, you've got to watch what happens with US policy. And it's very hard to keep track of what's going on at the moment in terms of US policy because it can be quite volatile, as you can probably appreciate. But at the moment, at least, the message we have is that things are looking a bit more positive in terms of the direction that the negotiations between China and the US are taking. And the market is certainly pricing that idea So that tariff that was supposed to come in place, the 25% tariff as of the early part of this year, got pushed back to the 1st of March, and then in the last few weeks it's been pushed back even further, sort of indefinitely, while they continue to do trade negotiations. So what am I telling you? What I'm telling you is global growth, which had been quite strong and above trend, has started to slow. I think it's going to slow a bit further into this year and a bit further into next year. However, we're saying that it's not collapsing, we're saying it's just slowing down. The market around the early part of this year would have been indicating that actually you should be really worried. And the market has now moved to a position where it says, well, actually, things are cooling a bit, but they're not really that. You shouldn't worry as much as you previously could have. The global economy is slowing, but not collapsing. What does all this mean for Australia? What does it mean for Australia? Well, I've spent a lot of time talking about it because, as I said, the shocks come from abroad. If you think about what happens in Australia, if you were to just sit and say what's going on in Australia and not think about what's going offshore, you're going to miss the big picture. And that's what you need. You need the big picture, and that's what I'm trying to bring to bear. Now, what's interesting about Australia at the moment is even though the global economy has been slowing down and China's growth has been slowing down as well, actually the effect that that's had on Australia has been fairly minor so far. And a big part of that, a big channel for that, has been that we've continued to see commodity prices hold up pretty well. Iron ore and coal price, a big part of what we export. It's not all we export, of course, but it's a big part of what we export. 65% of our exports is commodities. Those have actually held up quite well, and they're boosting national incomes, they're boosting GDP growth, they're supporting income in the economy. The challenge for Australia at the moment is while this is going on, and this has been supporting the overall growth story, and in fact it's been supporting the labour market too. The unemployment rate at the moment in Australia is at its lowest level in 7 years of 5%. The labour market's holding up quite well and the job vacancies are quite strong. We're also dealing with corrections that are going on in our housing markets. After a long boom in house prices in Sydney and Melbourne in particular, where house prices rose significantly. In Sydney, they rose by 75% in 5 years. In Melbourne, they rose by 60% over that same 5-year period. Both housing markets have now peaked in 2017, and they've started to fall, and that's starting to weigh on the consumer numbers. Consumers are getting a little bit more cautious about their spending. They're also quite cautious about their spending because it's been quite a long time now where we've had quite sluggish wages growth in Australia. And so the slower wages growth is discouraging people from doing quite as much spending. They've got a little less income in the scheme of things, and that's starting to affect the consumer. So when you think about your domestic tourism dollar, I know that's not the focus, but that is part of the story. You've got to keep in mind that households have been a little bit more squeezed because wages growth has been more sluggish and house prices are coming down in our major cities, and that's one of the challenges we face locally. But the global story, as I say, is also something we need to keep an eye on. So far, that global story hasn't delivered something negative for Australia. It's delivered some support. In particular, you're going to see this support in about 2 weeks' time or 3 weeks' time when you see the budget announced on the Tuesday, the 2nd of April. The budget is almost in surplus for the first time in a decade. And a key driver of that has been the income that's been coming through those commodity price channels. That's been supporting growth. And that's been supporting income growth, tax revenues, that's been supporting the budget. I think that's going to start to feed back into the economy come the budget as well. The short of it is Australia's growth is still holding up reasonably well. I think the clearest sign of that is still what's going on in the labour market, the fact that the unemployment rate is at a 7-year low at present and job vacancies are at record highs. And that should be somewhat helpful, but there are some challenges. One of the challenges is what might come from abroad. As I say, there are risks. And one of the another challenge is that we are dealing with this correction that's going on in the local housing market. So what does that all mean for your space? What does all that mean for the tourism industry? Well, when you come back to the overall story, the services export story for Australia as a whole has actually been quite positive in recent years. Now, you went through this really big cycle that had a big effect on Australia, on this particular industry, and it was a lot to do with what was going on in the mining industry, as you'll recall. So Australia had this exceptionally large mining investment boom when mining investment got to very, very high levels in 2011 and 2012, and commodity prices were extraordinarily high, and it crowded out all the other industries for a period of time. Right? That mining boom was just so large that in order to manage that mining boom, we had to have very high interest rates, which we did. The RBA had its policy rate at 4.75% back in 2011 when the Aussie dollar was, when the rest of the world had interest rates that were nearing zero, or the Fed was at zero as well. And back then the Aussie dollar, if you recall, back in May of 2011, the Aussie dollar got to 110 against the US dollar, extraordinarily high. Now, at that time, of course, that was a really tough time for this industry in particular. It was very hard to sell the tourism story to the rest of the world when they were paying over the US dollar in order to come here. And it was slowing down this industry. Plus, you had this effect that was going on from the domestic story as well, because of the mining boom and because of the high currency related to it, it meant that, of course, one of the ways that the mining boom fed through to Australians was allowing them more purchasing power over international travel. And so what they were doing was they were using their additional purchasing power, the high Aussie dollar, and travelling a lot more abroad and travelling less locally. And so that was slowing everything down. This industry was one of the industries that was really doing it tough while the mining boom was going on, when the Aussie dollar was as high as it was. A lot of that was really somewhat required, because actually what we needed was everything to slow down to make way for this mining boom, because the mining boom was just so exceptionally large. But the story since then has been a lot more positive for this industry. It's been a lot more positive because, of course, mining has slowed down, the Aussie dollar has fallen a long way as a consequence of that, and the lower Aussie dollar has stimulated growth in this industry, in the tourism industry, in the education exports industry as well, in the industries that tend to be quite exchange rate sensitive. And so if you collected together all of the services exports for Australia, including tourism, and you looked at how they've travelled over recent years, you'd say back in 2012, they were actually a drag on GDP growth of about 0.5%. You were losing 0.5% a year from those industries. But in more recent years, what you've seen is, of course, the Aussie dollar's come down, it's improved the competitiveness of this industry, and collectively services are now contributing about 0.5% to GDP. So there's been a really big swing in the overall story. Now, if you think of that in the context of the global story that I've talked through, China's development has been a really big part of that story. China has needed to build a lot of housing, a lot of infrastructure. During the global financial crisis, it pulled the lever on this large amount of infrastructure investment and drove commodity prices to high levels. And it made sense for Australia to tap into that, to build a lot of capacity and export a lot of resources to China, because the prices were very high. Well, China's growth is now changing. China's growth is now shifting. It's less about building infrastructure, less about building housing. They've already built a lot of that, and their economy is becoming more driven by services. Their middle class incomes are rising, their wages are rising, and they're being driven more by services. It's not just a China story, and I'm going to move on from that in just a moment, but it is China. China has driven a lot of this cycle in recent times. But because China's story is moving from being oriented towards building housing and building infrastructure more towards a services-oriented economy, of course, that's been driving a lot of what's come in terms of demand for what we produce too. The Aussie dollar coming down has been very helpful, and if you look at those Chinese numbers, for example, you've had Chinese visitor numbers that were running at about 300,000 visitors back in, or 350,000 visitors back in 2011. They're now running at 1.4 million. Right? You've got 1.4 million visitors. That's been the growth we've seen out of China, because China's growth is shifting. It's shifting from being oriented towards investment to being more oriented towards services, and that's driving rising demand. So you can see that the global story fits together with what's going on in the local story, and you've got to watch what's going on in those markets and what's going on overall. Now, for the tourism industry just specifically, thinking about the various opportunities and the various challenges, and I want to step through a few of those. I think the first opportunity that you've got to frame is that Asia is driving most of global growth these days, led by China, but it is an overall Asia story. The center of gravity of the global economy is moving from the Western world. It's moving from somewhere in the Atlantic between the US and Europe to somewhere between India and China, because most of the growth we're getting from the global economy is now coming from the Asian region. And that means that ought to be the focus of a lot of where we think our market's going to come from for this particular industry. As I've described, we've already seen a lot of that happening from China. There's probably a lot more yet to come from China. If you look at the numbers, you look at the exit numbers from China, we've had about 140 million people leave China over the past year. We think those numbers will be closer to 250 million by the time we get to the middle of the next century, so next decade, 2025. So there's still a great opportunity there. One of the statistics I really talk about a lot in this regard is, if you look at the Chinese passport numbers, it's still the case that only 5% of the Chinese population has a passport. Right, so there's considerable scope for a lot more of those people to get passports. That's going to be a medium-term story. And so the China story presents an opportunity. But it's not just a China story. And so there's an easy way to get trapped in just thinking it is. And I'm glad John showed all those various videos and the various campaigns about other areas. What I like to do is collect together the rest of Asia, excluding China. and think about what is going on with those numbers. I said earlier, the Chinese visitor numbers have gone from 350,000 in 2011 to 1.4 million more recently. But if you collect together the rest of Asia and you add them together, those numbers have gone from 1.6 million visitors back in 2011 to 3.3 million visitors over last year. Those numbers have got a stronger upward trend, in fact, than you're getting from the Chinese numbers recently. And so a lot of our focus ought to be on what's going on in Asia. If you sort of take some GDP statistics, some forecasts from the international agencies and think about and give it some sense of scale, how much demand are we talking about? If you look out to 2035 and you look at GDP, and you look at how much you're going to get, how much GDP growth is expected in Australia, in just the domestic market, and then you were to look at what's expected to happen in China and India and the US, obviously really, really big markets, and then scale those numbers to how much the domestic market is worth. So let me give you some sense of this. The expectation is that China's economy will grow by around about 150% over that period of time. The Indian economy will grow by a similar sort of rate. And of course, that's off a much larger base. What that means is, if you compared how much more market you've got in those economies by 2035 to what we will have here over that period of time, there's about 24 times more market that's going to come out of China than is coming from the domestic market. There's about 11 times more market that you're going to get out of India than you're getting from the domestic market, and a very similar scale in terms of the US story. So those are three key areas that we ought to be very focused on. But as I say, a lot of the story is broader than just China. It's also an Asia story overall. So those are where the opportunities are. Those are the opportunities you need to be thinking about for this industry. Another opportunity I think you need to keep in mind is, as the Asian growth story shifts from being about building infrastructure and building housing to being more about a services-oriented story, more about the middle-class incomes rising, there is a strong realisation here, I think, in Australia, by policymakers, by authorities, that Australia's growth story needs to shift as well. We need to be We obviously have a very competitive mining industry. It's a big part of what we export, and it's going to continue to dominate our exports for quite some time. It's 65% of what we export is commodities by value. So it's a very large share of what we do. But the next growth story that's coming in Asia is all about the services sectors. It's really the dominant story is going to be rising middle class incomes, populations that are getting richer, wanting to consume more of their services. In China already, more than half of the overall economy, overall GDP, is made up of services. More than half of the overall GDP growth is coming from the services sectors, and you're seeing that reflected in those tourism numbers. So Australia is in a process of needing to shift its economy as well, from being more oriented towards producing services for the international market, and this is one of the key ones. So I think that's another plus that you should think about in terms of an opportunity. Finally, on another opportunity, before I move on to some challenges, on the other opportunity, I think, is that cycle in the Aussie dollar that we saw, the very, very high Aussie dollar back in 2011 at over US dollar parity. Well, we don't think that's going to happen again. We think that that was really a one-off event in terms of what if you look at the scale of the mining boom that went on, it was exceptionally large. It just doesn't seem likely that we're going to be looking at anything like that in the future. In fact, HSBC's view is that the Aussie dollar probably falls a bit further. So one of the things that you should keep in mind is the Aussie dollar is now offering a lot of support for this industry. It's a key variable when thinking about where the international dollar comes from and whether international visitors want to come to Australia, is where the Aussie dollar heads and how that plays out. So the risks, the challenges we face. Well, one of the challenges we face is that global slowdown that I talked about right at the beginning. And we have to keep that in mind. And that's something certainly that we need to deal with, is that the global growth is slowing, and that opportunity might change a bit. Within that, you then have to look at which countries are likely to be the ones that will perform a bit better than others. Certainly Europe has slowed down a lot recently, and I think if you're looking further forward, there's going to be quite a few challenges there. I think Asia is still the dominant story. So the challenges we face are that some of those more traditional sources of tourists might be a bit more challenging going forward. I think another risk, obviously, is geopolitical risks. One of them is related to trade policy, what I just described, and that could have a reverberating effect through other sources as well. It could be the case that in trade negotiations that go on in one particular area, it starts to have an effect on flows of tourists in another particular area, and that's something we need to watch quite carefully as well. We've seen examples of this happen in the past, and I think this is something that is a risk we've got to definitely keep in mind. Now, finally, I want to talk about some very specific things for very specific markets, because if you sort of think about the story and break it down to individual countries, I want to point out a few specific things for those individual countries on a sort of listing basis of the major sources of where the tourists come from for Australia. So I put at the top of the list Southeast Asia in general. That's kind of how I think about it. As I say, 3.3 million visitors from Southeast Asia. And I think when you look at that, things like tapping into the India market is a very important aspect of what we should be doing. And that, a part of that stems from the fact that we've already actually got really strong ties to India, in particular through migration flows. If you look at the migration numbers that come to India, China and India are around about the same in terms come to Australia. China and India are around about the same. So if we've already got those connections in terms of migration flows, it makes sense that we should be thinking that India is a next market we ought to focus on. Over the past year, you've had 350,000 visitors from India. You've had 1.4 million visitors from China. Obviously, India's still its per capita income is a whole lot lower, but think about the China story in that context. China 5 years ago, or 6 or 7 years ago, was at similar numbers to India, and now you've seen that strong growth out of China. So India is certainly one of the areas that ought to be focused on. I think the other thing to keep in mind is we tend to think about all of the other individual Asian economies and sort of as individual countries, but you need to think about them a bit more. It gives them more heft and more scale to think about them as a region. The whole of Asia, as I say, is the dominant force in terms of the overall visitor arrival numbers for Australia. So if you then move on to the next on the list is New Zealand. New Zealand's the next big source of people who come to Australia. We know what that tourism dollar looks like. It looks a bit more like people coming to visit friends and family and those sorts of attachments, people coming across from New Zealand because they've got working rights and so on. It's a little bit of a different beast, but the New Zealand economy is actually tracking quite well, so it's worth keeping that in mind as well. Then you move on to the US, which obviously there was a big part of the campaign that's been going on. I think on the US that there are great opportunities there, and part of it is that the US economy's been doing very well. As I said earlier, US growth was running at 3%. The unemployment rate's at its lowest level in 5 decades. If you can't get them to spend money, the tourism dollars now, this is the point at which you might expect it. And I would put this out as a challenge, but the numbers are picking up for Australia in terms of visitors that are coming from the US. I think we had something like 800,000 visitors last year, and they are rising, but they're rising faster in New Zealand. So you've got to keep that in mind. If you want some aspect of competition here, over the past 5 years, we've seen, I think, 56% growth or 55% growth here in Australia over the numbers from the US. In New Zealand, those numbers have more than doubled. They've gone up by over 100%. So if you want an aspect of competition, an area where we ought to be looking for an extra bit of spend, that's from the US tourist as well. As I say, they're going to New Zealand. They ought to be coming here too. And so that would be one area that I would point out. And then finally on the UK, which of course we're watching, or at least I'm watching, minute by minute, day by day, as to what's going to happen there with regard to Brexit. No one knows. No one can know with certainty. There was a vote overnight that they've decided they're not going to have a no-deal Brexit. That doesn't seal the deal yet, though. They have to have a vote tomorrow and decide whether they're actually going to try and push back the deadline for Brexit. There's a lot of moving parts in this story. And of course, the UK is the next on the list. I think we've had about 750,000 visitors from there last year. Those numbers have slowed down a bit, and so Brexit could be a big deal, obviously, for that story. A lot of how that would work, I think the mechanism would be partly, if Brexit were to be messy, it would be bad for the economy and therefore discourage people from travelling, but also it would come through the pound and what happens to the currency. Our FX team have been very agnostic about whether Brexit's actually going to happen or not and how it's going to happen, because it's pretty much anyone's guess to work out how it's going to flow, but they've taken the view that if there was a no-deal Brexit, which seems now unlikely, the pound would fall to 110. If it all goes smoothly, the pound might be back up at 155, and they've sort of picked the middle point and said, well, we'll take the average of those things, but obviously the events overnight push you sort of more in the upward direction than the downward direction, which suggests a bit more support for the overall story. So I hope I've tried to cover a lot of territory in a fairly short period of time. I've tried to talk about the global economy, the local economy, and a bit of what's going on in terms of the tourism industry. I think the main takeaways for me that I want to sort of deliver are that global growth is slowing and there are some challenges out there. We need to watch them quite carefully, but I think don't get overly nervous about it, because I think things are slowing, but they're not necessarily collapsing. I think the other big message is our big focus in terms of our overall growth story for Australia is that we're highly tied to the fastest growing region in the world, which is Asia, and their growth is shifting as well. It's becoming less investment oriented, more services oriented. It's more about them consuming things, and so that's the big opportunity in the big market. China's a part of that, but it's not the whole story. India is a big part of it as well over time, and actually there's a lot of other small South Asian economies that we are already tied into, where those ties can get even stronger, and that's a lot of what the opportunities are. In terms of the main variables you need to keep track of to sort of keep track of what's going on, one of the fundamental ones is, of course, the Aussie dollar and how that tracks, and I've delivered hopefully a reasonably good hint there that we are of the view the Aussie dollar's probably got a bit further to fall. Our FX team have in mind 66 cents by the end of the year. That's what they've got factored in. So a lower Aussie dollar is obviously one of the fundamental things that helps to support the competitiveness of this industry. I have got 10 minutes remaining, and this was on purpose. The idea was that I've got 10 minutes to take a few questions across the room. Perhaps you've got questions about what I've said, or maybe some aspects that I haven't touched on that you'd like to hear a bit more about. I think there are some microphones.
Hello, Sarah from Shoalhaven. The big shift in generations and the zeitgeist really about reducing waste, reducing your impact on the planet, reducing plastic use and all that sort of stuff. How do you see that as affecting, as that generation moves through and matures and takes up powerful positions within our economy and our industries? How do you see that as affecting your world in the next 15, 20 years?
I think it's a big effect. I mean, this is a really important issue, and what you're touching on is mostly environmental issues, and a recognition that we have to have sustainable growth rather than just all-out growth. I guess one of the things I sort of take is I'm quite optimistic about this story. I think there's a lot of action going on actually at present globally. In terms of trying to deal with this making our growth more sustainable. And technology is also helping this story a lot, right? So, for example, the single largest producer of carbon emissions is power generation. That's where we get the most amount of carbon emissions. But the renewables technology in that space, in energy generation, has been improving so rapidly, and the cost has been falling so quickly that we're waiting for governments to mandate things. But the thing that's really changing is it's becoming competitive. Like, it's becoming cost neutral or maybe even cost beneficial to move to renewable sources for various types of energy generation. Overlay that with actually globally, we've got big movements going on. For example, the Chinese authorities, and I know people don't think of the Chinese authorities as delivering necessarily environmental policy, but their environmental policy has shifted significantly in the last couple of years. From about 2016 onwards, they've really, really ramped it up. So much so they're cutting back on the domestic production of low-grade coal. They're changing their manufacturing processes. They've mandated that a certain number, 12% of all motor vehicle sales by 2020 need to be electric vehicles. They're the leader in that space. They're the leader in terms of battery storage. The list goes on. They're importing more liquefied natural gas instead of using coal to generate energy. And so that's one movement. And then you look at what's going on in the US, and I think there's a very divided story there. But you look at this idea of moving in that direction too. That to a degree that's going. So I have a relative amount of optimism that this is actually going to technology is going to allow this process to happen. It's going to happen within the framework rather than necessarily being forced upon us. And as I say, I've sort of some optimism in that space. But it's also very much worth watching in terms of what it means for every industry, in terms of the implications it has for where your growth is going to come from and what people are prepared to do and the activities they want to take part in. So I'm glad you raised it. Thank you.
Hi, Paul. Russell Mills. Just following on from that question, the Reserve Bank Deputy Governor, Guy Debelle, mentioned yesterday that climate change is now a consideration in monetary policy. it's significant when you tie money to or climate change to money. It's obviously something shifting. What are your thoughts on that? I guess you've just expressed that market-driven optimism, or you've got optimism based on technology driving market-driven responses. But when institutions start saying things like that, does that shift things? What are your thoughts on that?
Well, absolutely. I think that, I mean, the major fundamental point here is that, you know, when you're thinking about what monetary policy is trying to do, it's trying to keep growth stable. And so one of the points that was made was that, you know, climate change is making things more unstable, for example, in agricultural markets. So that's something you need to keep an eye on and watch carefully. I think the other thing is environmental policy is obviously impacting on the capital stock and the structure of how we drive growth. And so there's a shift that's got to happen there as well. And again, it has implications for prices, which then has implications for monetary policy. So I think I mean this is something central banks are definitely taking into account in terms of their thinking, and it's actually in some ways very good to because central banks are independent from the political process. So it's good to have an independent authority speaking out and saying this is how we're seeing the challenges, and hopefully that provides some guideposts for policymakers in other areas. Let's say. In the middle here, and then over there.
Bob. Aviation is obviously key to so much of what we look at doing, and there's about 30,000 planes in the air, and there's about 2,500 extra a year, and we just saw what happened with Boeing. So we often look at the affordability, and that comes to oil prices. And does HSBC have a view on oil? I know it's incredibly hard, but does it have a view? Because it actually moves the dial more than currency, I would.
It's incredibly hard, but we have to have a view, yes. So we do. I mean, so the oil price has been through a roller coaster recently. I mean, if you think about where it was back in October, we were at $85 a barrel on oil, and there was a broad expectation actually in the market that maybe it might even go even higher. And then the oil price plummeted from 85 in October. It got down to a low point of $50 a barrel just before Christmas, and now we're back up around $65 a barrel. So I think you can think about the oil price as sort of being driven by, you know, it's supply and demand. The demand story hasn't been really the key driver of that volatility recently. A lot of it's been a supply story. So we had this sort of perfect storm happening late last year on the supply side. A lot of supply came to market. Saudis delivered more supply than was expected. The US shale producers ramped up production a lot more than they had thought, and that was one of the things that pushed oil prices down lower. And then recently the lift has been because, well, there's been more constraints put in place from OPEC. If you remember, OPEC had a meeting back on the 6th of December and said that they wanted to take, it depends how closely you follow this story, of course, but 800 million barrels a day off the global market. And in fact, what they've done is outperform that. They've taken a lot more off. So the short version is this. Yes, we think the oil price is, our forecast is the oil price stays around where it is, by the way, at 65. We've got 64 as an average for this year. We've got 70 next year and 70 the year following. And what we're seeing right now is this sort of big sort of tug of war in a way between the US shale producer and OPEC. Because the US shale producer, when the oil price goes above $70 a barrel, can really ramp up production, pour more oil onto the market, pushes the oil price down. But OPEC countries in general, Saudis in particular, don't like oil prices going down much below $70 a barrel, because below that level, they get below their fiscal break-evens. They don't have enough, they run into budget deficits, and they don't like that. So there's this tension between the two going on right now, and we think that that's probably the best way to think about the oil price going forward. Well, if oil gets above $70 a barrel, there's more shale coming. If oil falls below $70 a barrel, well, then OPEC tries to pull some supply off the market. So that's kind of the framework we're using for thinking about oil, and that's the forecast we've got in mind. $70 a barrel is about the break-even for the market. I've got time for one more question before Sophie kicks me off. Just here.
Hello, Paul. I'm Vivian from SA Tourism Commission, and my job is more relative to Eastern markets. So, very glad and really enjoying your comments about the Asian as a region. So a lot of comments about China and India, but as you said, Asia as a region also have very strong growth. Do you mind just to dig a little bit deeper, have some top-line comments about other already engaging markets such as Southeast Asia, Singapore, Malaysia, Indonesia, and Japan for our inspiration as well? Thank you.
Absolutely. So those are 4 countries that would be ones you ought to remain focused on. I think actually the numbers from Singapore, Malaysia, and look quite good. The Indonesia numbers probably not as much in terms of inflows. Singapore and Malaysia are wealthy countries with strong attachments to Australia already, so that tends to drive a lot of the connections, and I think there are continued opportunities from those places. Indonesia probably you'd put in the same sort of basket as India, where its level of development is still quite low, but there's an enormous scope for it to keep growing. I mean, when we think about India and Indonesia, India is currently the fastest growing large economy in the world. Its growth is running at about 7%, and we think that's going to persist. Indonesia's growth is similar. It's a little bit less than that. It's sort of around 6%. But Indonesia is a similar sort of, 240 million people developing as they are, and so this should lead to more opportunities in that market as well. Japan's a bit more challenging. It's a traditional market where we have got strong ties already, and so a large share of, I think it might be even the 5th largest individual source of of tourists that come to Australia. But of course, it's got its own challenges. Its population is aging. It hasn't got a strong migration program, so its population is actually shrinking overall. And so, I suspect that the opportunities there might get tougher, although ageing populations can lead to different opportunities too, because there might be more people who are prepared to spend a bit more towards as they get to older years. So those are some thoughts, but I think that's the right line of argument, which is that, and that's kind of that was a lot of what I was trying to point out, is we do focus on China a lot because it's a huge market and it's been growing quickly. We need to think of Asia more broadly and think about all those individual markets that are in there, because actually if you add those numbers together, they're bigger than the China numbers. They're bigger collectively than the China numbers, and so collectively, all those Asian economies are an important part of the overall story, and they're a lot of where the opportunity is likely to come from going forward. I hope that was helpful. Thanks for the invitation.